Good afternoon. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. I want to welcome you all to our conversation today about crypto, digital assets, and the future of the payment system. Now, I found that conversations about crypto can be overwhelmingly sprawling, from intricacies of the blockchain and what the heck are NFTs anyways, to this debate about whether crypto is a commodity or is it a security, to concerns about illicit finance, to some really big questions about trust in government, economic power, and financial inclusion. So today we're going to focus on a piece of this, the role that crypto and other digital assets are playing and could play in the payment system, and how best to get the benefits of innovation while protecting consumers, investors, and the stability of the financial system. Now, a payment system is a set of rules and processes for transferring money: checks, ACH transfers, credit cards, Venmo, PayPal, Apple Pay at the retail level, all of which go through the banking system and are overseen in one way or another by the federal regulators. The system works, but it can be slow, it can be inefficient, can be costly, particularly for cross-border payments, and it doesn't reach every American. So the question really is whether recent innovations, instant payment systems, stable coins, digital currencies, someday even a central bank digital currency issued by the Fed, can solve these problems or create new ones. So that's sort of what's on the table today. We're going to start with a presentation by Nellie Liang, who's Undersecretary of the Treasury for Domestic Finance and former member of the Hutchins Center team. Nellie, who previously was the Director of the Division of Financial Stability at the Fed, is going to talk about a series of reports that the administration, particularly the Treasury, has done in response to an executive order for the president just on these topics. And after her presentation, she's going to join a panel, which I'll introduce when she's done. If you have questions, you can send them to us on Twitter at #digitalpayments or on the website Slido, sli.do. Again, #digitalpayments, and we'll monitor both of those and ask the questions as best we can in the hour we have. So with that, Nellie, welcome back to Brookings, and the floor is yours.
Thank you, David. Thanks for the introduction, and thanks for inviting me to speak today on this topic. It has been a journey of many agencies, many regulators, industry participants, academics, to focus on this issue, and we really appreciate the opportunity to talk about this today. So this is work, including recent reports by Treasury that I'll focus on in response to the President's executive order on ensuring the responsible development of digital assets. And the remarks today will focus primarily on how digital assets could shape the future money and payment system in the US, and recommendations in the report to prepare for that. But I want to first take a few minutes to talk about the here and now of digital assets, how they are currently being used, and their effects on consumers, investors, and businesses. And I also want to note that next month, the Financial Stability Oversight Council will be issuing a report on the financial stability risks of digital assets and regulatory gaps in the system. So to start, the first report that I want to talk about is Crypto Assets: Implications for Consumers, Investors, and Businesses. And the charge for this report was to focus specifically on current uses for crypto assets, and especially use by and effects on vulnerable communities. And a main finding of the report is that the most prevalent current uses of crypto assets are for trading, lending, and borrowing, and use of crypto assets to deliver other types of financial services like payments at lower cost, higher speed, and without intermediaries has not materialized yet. And the report finds significant areas for concern. There are frequent instances of operational failures, market manipulation, frauds, thefts, and scams. Consumers and investors are exposed to improper conduct, for a variety of reasons, including a lack of transparency, non-compliance with existing regulations, as well as that crypto assets are novel and rapidly developing. In addition, while the data for populations vulnerable to disparate impacts remains limited, available evidence suggests that crypto asset products may present heightened risks to these groups, and there's been little evidence to date of financial inclusion benefits. Based on these findings, our first recommendation is for agencies to continue to aggressively pursue their enforcement efforts focused on this sector. And a second recommendation is for agencies to clarify their existing authorities to ensure they're being applied appropriately to crypto assets, and for regulators to work cooperatively so they can be more comprehensive and increase compliance with existing rules. And these recommendations recognize that agencies, including the CFPB, SEC, CFTC, DOJ, others, have been hard at work to address harmful activity and to protect consumers and investors. Agencies have expanded and prioritized resources. And this recommendation also reflects the principle that financial services, whether provided through crypto technology or traditional financial firms, should be subject to the same rules if they pose the same risks. That is, we believe these rules should be technology neutral. The reports also recommend that agencies work together through the Financial Literacy and Education Commission, for example, to improve the quality of information about crypto assets. And the goal is to make trustworthy and consumer-friendly materials accessible and inclusive. So let me turn next to the report on the future of money and payment systems in the United States. Here we focus on digital assets used for money and payments, as well as instant payment systems. And we make a set of recommendations to put us on a path to a more efficient, innovative, and inclusive money and payment system, and to reinforce US global economic and financial leadership. The current money and payment system has many strengths. The system has supported over a century of US growth, processes an enormous volume of transactions, and supports privacy, civil rights, and other democratic values. But some parts of the system are expensive and carry high fees, and other parts are slow. It is also not as inclusive as it could be and should be. The percentage of the US population that is unbanked is higher than in all other G7 countries. Looking forward, recent innovations in digital assets and other technologies could have far-reaching implications for money and payments. These innovations include a central bank's digital currency, a CBDC, retail instant payment systems, and stablecoins. The report builds on the work of the President's Working Group on Financial Markets, which recommended legislation for consistent and comprehensive oversight of stablecoins. The report does not make any new recommendations regarding stablecoins, but instead considers the implications of stablecoins for the payment system. So let me now just turn to the recommendations in the report. I'll turn first to CBDC. So CBDC, just as a reminder, is basically a digital form of a country's sovereign currency. It's a liability of the central bank. It could serve as legal tender, be convertible one-to-one for paper currency or reserve balances. It would clear and settle with finality and nearly instantly. The report's first recommendation is for the US to advance work on a possible CBDC should one be determined to be in the national interest. There are many important design choices that require additional consideration. For example, a US CBDC could be retail, meaning broadly available to the public, or wholesale, limited to financial institutions, and it could use direct or indirect access models. Choices such as these could affect the availability of private credit in normal times and in stress periods. There's also a need for further research and development on the technology to support a US CBDC, which could take years. For the US to build the capacity to adopt a CBDC, even as deliberations continue about whether one is in the national interest, the report suggests work in a number of areas. In addition to supporting continued evaluation and periodic updates to the public by the Federal Reserve, Treasury will lead an interagency working group to support the Fed's efforts and advance further work. The working group will consider the implications of a CBDC in areas such as national security, financial inclusion, and privacy. Leadership from the Federal Reserve, the White House, and Treasury will meet regularly to discuss the progress of this working group and to share updates on CBDC and other payments innovations. Turning to instant payments, retail instant payment systems transfer funds nearly instantly, as opposed to the multi-day settlement period that occur on some legacy systems. In the US, examples include the clearinghouse's RTP network, launched in 2017, and the FedNow service, which the Fed plans to launch in 2023, next year. Global experience suggests that instant payments can contribute to making the payment system more efficient, inclusive, and innovative. Yet frictions may limit the extent to which potential benefits of instant payment systems are realized. Consumers, businesses, and financial institutions may be slow to adjust their habits and procedures to new technologies. In addition, instant payment systems are generally accessible only to depository institutions. So to maximize the benefits from instant payments, the report suggests efforts in 3 areas. First, the US government should continue outreach efforts on instant payments with a focus on inclusion of underserved communities. Second, the US government should promote development and use of innovative technologies that allow consumers to more readily access instant payment systems. And third, in settings where appropriate, US government agencies, which send and receive millions of payments a day, should consider and support the use of instant payment systems. The report's third recommendation is to consider establishing a federal regulatory framework for non-bank providers. This recommendation recognizes that non-banks are increasingly providing payment services and are contributing to enhanced competition, inclusion, and innovation. But today, oversight of non-bank payment providers is generally at the state level. It varies significantly, and it may not address risks in a consistent and comprehensive manner. A federal framework could provide a common floor for minimum financial resource requirements and other standards that may exist at the state level. It could also complement existing federal AML CFT obligations for illicit finance to deter illicit finance and consumer protection requirements that apply to non-bank payment providers. A federal framework for payments regulation could work in conjunction with a US CBDC or with instant payment systems. It could provide oversight of firms that a potential US CBDC may rely on for a range of financial services. It could also lay out a path for non-bank payment providers to participate directly in instant payment systems. The report's final recommendation prioritizes work to develop a faster, cheaper, and more transparent international payment system, while considering the potential risks of greater integration of cross-border payment systems. Indeed, private sector innovations have been driven partly by the inefficiencies in our current cross-border payment system. Cross-border payments can take days to clear and have high fees. And the US has a strong national interest in supporting global standards for cross-border payment systems that reflect US values, including privacy and human rights, are consistent with AML, CFT considerations, and protect national security. So to conclude, as laid out in the executive order, new technologies, when developed responsibly, can lead to significant efficiencies and further innovations. The Future of Money and Payments report set out a set of recommendations with a deliberate path forward to determine if a CBDC is in the national interest and to support the responsible development and adoption of other innovations. This path should achieve the potential benefits of innovation while mitigating risks to consumers and to economic growth and stability. So thank you for the opportunity to present those.
Thank you. Thank you, Nellie. I forgot to give my usual admonition about keeping acronyms to a minimum. So AML, money laundering, and CFT, combating the financing of terrorism compliance. I can't promise we'll stick to that, but I'll try and ask people to identify their acronyms.
Sure.
So thank you very much for that good overview of the Treasury reports, which are quite extensive. I'm really pleased by the panel we've assembled today to discuss this. Tanansin Carmona is a Rubenstein Fellow in our Brookings Metro program. Before joining us, among other things, she was Chief of Policy for the City Clerk's Office in Chicago, where, among other things, she launched Chicago's Municipal ID card, which simultaneously serves as a transit and library card. Paige Paradon is Senior Vice President and Senior General Counsel of the Bank Policy Institute, which I should note is a donor to Brookings. Before that, she was with another banking association, the Clearinghouse. And before that, she was at the Fed, where she was responsible for every rule written under Dodd-Frank, right? Is that right? So if you have any complaints about Dodd-Frank, talk to Paige. And finally, but not least, we have Kristen Smith, who's Executive Director of the Blockchain Association, which is, the name implies, looks out for the interests of the crypto industry in DC. She's been there for 4 years. Before that, she was a lobbyist and worked on the Hill. So thank you all for joining us. Kristen, I want to start with you, and I think we'll get into some of the details, but a number of people have posed sort of an underlying question, which is, what exactly are the problems that we think are best solved by these new technologies, whether it's Bitcoin or stable coins or all that, that can't be adequately solved by the existing payment system if it was just got on with it? The instant payments to which Nellie responded, the bank Zelle things. What is it that digital assets, crypto, does that these other things can't do or can't do as well?
Yeah, no, thank you, David. And I think it's an incredibly important question. And, Bitcoin was the very first cryptocurrency. Since that time, there are many other assets out there. But the big innovation there is it allows for a digital peer-to-peer transfer of value. And, if you think prior to Bitcoin, there really wasn't a such thing as digital scarcity on the internet. That's why you didn't see an internet native money, because the problem is you would spend something one time and then you could spend that again and again and again. And all of a sudden it has no value because, you have no scarce element to it. So Bitcoin allowed for these peer-to-peer payments to be done because the blockchain maintains the ledger for who has made what transaction. And stable coins have been an attempt, and there are many, stablecoin is a term that is used to mean different things. I think from my perspective, when we talk about stablecoins, we're largely talking about dollar-backed stablecoins, but there's been an attempt to do other models. What stablecoins have attempted to do is that, hey, we like these features of being able to transact 24 hours a day, 7 days a week, 365 days a year, in really big amounts or really teeny tiny amounts instantly without an intermediary. And stablecoins have been an attempt to do that with digital assets in a way that doesn't have the fluctuations that you see with Bitcoin or some of the others. And so we think these are all really desirable qualities. Today, the stablecoin market is about $150 billion. Most of the testing of stablecoins have been done in the trading of other digital assets. So it's actually a pretty high bar testing ground, because the demands of this ecosystem that are participating in this trading, these are very sophisticated actors that are moving things very quickly. And the thinking is, boy, if it works in this context, it could probably work really well for smaller everyday payments as well. And so I think that's a transition that we're starting to see. But I would say the one thing to note is when you have less intermediaries, the cost of the transaction is significantly lower. And every intermediary intermediary that's in the system today, takes a piece of the transaction. So if we can reduce those and allow people to transact more directly, then the cost of making those payments are cheaper.
So from the point of view of an ordinary consumer, I don't know about you guys, I don't generally move $1 million a day. You're saying that why can't we do this with a real-time payment system? Why couldn't this be done with Zelle or Venmo or the next generation of those, where the intermediaries, in part because of the competition from the decentralized finance people, are basically forced to bring the transaction costs low? Is there some advantage to taking the intermediaries out?
Yeah, no, I mean, I think the advantage is just that, right? I mean, as you just said, they're forced to cut their fees because there's competition. I think the more options that consumers have, the more inclusive our financial system would be. And I think that by being able to transact on a peer-to-peer basis, you can effectively reduce the cost of that transaction to nearly nothing. And I think that's a good thing. It doesn't mean there's not other ways to do it, but I think having multiple avenues out there are really, really good options, because when you reduce the fees, you can start to do micro transactions, right? Like imagine every time I went to a website and I could read an article and pay a fraction of a penny in order to compensate the author of that article. There's a lot of interesting things you can do. And the other thing that I left out that's actually hugely important with stablecoins is they're programmable. And so you can have these payments automatically be made when certain conditions are met. And that's something we haven't, seen in the traditional finance space.
So
doesn't mean that those aren't good as well, but this is an alternative that a lot of people found value in.
So Paige, let me put the same question to you. Do we need stable coins and crypto, or could we do it all without it?
Yeah, thank you. And thank you so much for having me. And I really appreciate being here with all of these esteemed panelists. Yeah, I mean, I think, as BPI has kind of posited in some of our prior writings and speaking engagements, we don't yet see that there's a need to turn to a stable coin or a crypto or that type of asset in order to speed up payments. Obviously, we have P2P payments right now through Zelle, through Venmo, PayPal, and then on a larger scale, I think you referenced, RTP and FedNow, which will be coming online in 2023. But, additionally, the idea of a digital representation of a deposit or a store of value to use also as a means of transaction is something that the banks themselves are innovating in and looking at via tokenized deposits and blockchain-based deposit accounts. So leveraging the benefits of kind of this evolving technology, the benefits that a distributed ledger may present, as Kristen noted, but doing it sort of within the supervisory and prudential regulatory framework that banks are subject to, and backed by FDIC insurance. So from our perspective, at least right now, in addition, our banks we've discussed a lot of these developments with members, and they have not yet had customer demand for retail-based stable coins or crypto assets as a means to make payments or P2P transactions.
Right. I think everybody acknowledges there's not much retail ordinary demand for stable coins. As I read the sense of the Treasury reports and other commentary, is that we should figure out some guidelines, some rules for this, because they could very well be used. And we've kind of learned the hard way, when you let sometimes these things multiply, they can pose risks to the system and to individuals that we weren't prepared for. And given that we're in a world here where there's not a lot of regulatory clarity about who's in charge of what, and there's a lot of ferment here, it seems to me it's good to be, in this case, it's good to be ready. I was on a call earlier today where somebody in the industry said, yeah, but the regulators are going to choke off all the innovation. before we can actually figure out how to use these things, and that's of course the balance. So Tananzin, where are you going to put yourself in the Page Kristen spectrum here? The best thing we ever did, or totally unnecessary?
Oh my gosh. Well, first of all, I'll just say that I appreciated the question because it's a lot to unpack, and the thought-provoking framing, simply because I've often wondered if we in the United States had already had a robust real-time payment system that was accessible to all the way that other countries have figured out, would we be having as many conversations as we've had on CBDCs, crypto, stablecoins? And so, and even listening to Undersecretary Liang's remarks, she mentioned specific areas for improvement in the payment system. It was, parts of the system are slow, they're expensive, they're inaccessible to the unbanked community. And so if we actually start with the problem and pain point, the real-time payment system that, is scheduled already to be introduced would likely address some of at least the speed issues, and then likely cost issues. And so then you kind of go back, well, do you really need crypto and stable coins, given that they come with all of these added operational risks? And to what the data is showing, people aren't really using cryptocurrencies or stable coins for making payments. They're using them largely to trade or, to use the larger crypto ecosystem. And on the innovation that Kristen was talking about in terms of the P2P, that it's, gotten rid of intermediaries, I'd actually argue that we didn't. We just have a whole new set of intermediaries that now we have to think about, and that they themselves are presenting a whole new set of risks. So I'm obviously of the mind that crypto stablecoins are probably a solution in search of a problem, but I'm happy to hear out some of the other panelists as we continue on the discussion.
So Kristen, I think you deserve a chance to respond. So let me ask you to respond, and then if you could speak a little bit to what the things that the Treasury is talking about in this report. Some of them are, sorry about this now, a little vague, but some of them suggest the direction they're going. I'm sort of curious, A, how do you respond to what Page and Thompson said? And secondly, how do you feel about the direction that the administration is taking here?
Yeah, no, I mean, listen, I remember when I was might have actually been middle school or maybe high school, when I got on the internet for the first time and I tried to read a news article. It's probably well, why do we need this? We've got paper magazines over here. And yeah, it was maybe a mild improvement, maybe not, because you had to tie up the phone line to dial on. It was sort of a pain. That doesn't mean that wasn't an important step to getting to a point where, right now we're on this path to having programmable money. And I agree, it is not used for payments today, but that doesn't mean it can't be used on a wide scale for payments tomorrow. And I think there's a lot of interest in being able to reduce those transaction costs, make it easier for businesses to keep more of the money that they're making, make it easier for friends to transact with one another. When you are using Zelle or Venmo, you do go through multiple intermediaries there. It may feel peer-to-peer on the end, but underneath that, it's not as great. And then particularly when you're transacting overseas and sending remittances back home, those fees are so high, they're taking a big part of people's money that they're trying to transfer to their loved ones. So I think there's a lot there. And again, this programmability idea that a payment is initiated or some kind of complex transaction when certain conditions are met, that's something that's not available today. So we do think it's worth it, but I agree, it's not something that everybody is using today. I would say in response to Treasury's reports, listen, I'm not going to sugarcoat it. The crypto industry, because it is early, has had a rough year, right? There were some really bad things that happened in the marketplace, and I'm glad to see that some of the bad actors are getting weeded out, and some of the crazy experiments that should never have gotten that big are going away, because those aren't good for consumers. And we certainly don't want that to be what crypto is. We think it's a much, much broader thing. And so it's understandable that the reports, we think, took maybe overweighted some of the risks that are out there, though there are risks, and failed to sort of acknowledge the promise or potential of the technology. But that being said, I think that the president's working group did a pretty thorough job looking at this already. And we would, the industry is very eager to see a legislative framework put in place, it will provide more regulatory home options for stablecoin issuers. We think there needs to be audits. We think that there need to be guidance for how you can manage the reserves. We want to see more consumer protections in place, because I don't think we're going to be able to get to that next level where this is utilized as a payment technology until we have that regulatory framework. So I think we need the regulation. But what we have that some of these other ideas don't have is the technology is here. It works. It can be deployed. Like, we don't have to go through the process of trying to build a new system. The system exists, but we just need to have the right framework so that we have more, sort of regulatory framework, so that the usability and the consumer adoption, they'll have more confidence in the system if we do have some regulatory oversight.
Thanks. So Nellie, I want to ask you a little bit about the current thinking on stable coins.
Yeah.
As was said earlier, stable coins are a cryptocurrency, but it's the ones we're talking about are linked to the value of the dollar. And the idea is that if you have a token, say one issued by a company like Circle, you can turn it in for a conventional dollar bill or dollar bank deposit. So right now, it's kind of, lots of people are issuing them. There's not much, as far as I can tell, discipline in the market. Initially, the president's working group talked about this as that we would maybe limit this to, in the jargon of the trade, insured depository institutions, like banks would issue them, just the way banks can make deposits and checking accounts. But in the report, you talk a little bit about non-banks. And I'm just sort of curious how you're thinking about, if stable coins are going to develop, how do they fit into our existing set of financial institutions, banks versus non-banks? And is this something that we can address with regulation, or is it going to have to take legislation from Congress?
Yeah. So linking it back to the first question a little bit, reframing your first question is about from what are the problems that could be solved to what should the future system look like? And I think the approach has been in these reports, and even in the PWG report, to allow for multiple technologies and allow them to develop, but with the right guardrails. And it could turn out that in the future, some of these will go away and won't work. But and as with our payment system, we still have cash, we still have checks, we still have, everyone, Apple Pay and Zelle. And so it's not like one eliminates the other, and different options, I think, are useful. So stable coins, I think we saw that, the PWG report saw that as an innovation that could currently being used in crypto trading, potentially could be used more broadly for payments on a more broader scale. And I think the main initiative of the PWG report was to identify the key risks. And they were the run risk, because it's linked to the dollar, and were the reserves adequate. They were the payments risks, that have to do with redemption and the custody and safety of your holdings, et cetera. And the basic recommendation was for Congress to write legislation on this, that the existing regulations among the securities regulators, among the prudential regulators, really was not sufficient to address these particular risks. So in my view, I do think we need legislation. We proposed in that report an IDI framework, which is sort of, in my view, code for a prudential regulatory framework that has not just disclosure and transparency as its fundamental feature, but some oversight into the redemption features, the payment features, look at the reserve assets, that kind of thing. So we proposed a prudential framework. That was one proposal. There are plenty of others. This generated a lot of conversation. That was the intent. There certainly are proposals out there for some kind of firm that would have prudential regulation, but does not have to have the full set of IDI regulations. I think that's really where Congress is, where the discussion is right now.
So Nellie, a couple of people online have asked a question about if if we have stable coins and the stable coin issuers are required to keep their money in dollars or short-term treasuries, then obviously we're not going to allow them to lend it out the way that banks lend out their deposits. So is there a problem here if stable coins get really big that we may interrupt the flow of credit in the economy?
So if they invest, I mean, in some sense, you could say we have money market funds, I think, and that hasn't, it flows in a different way. It's not through banks, but banks could offer stablecoin products. I don't think it's like, if you allow non-banks under some formulation, if some non-banks were to offer, it does not mean banks couldn't offer. So just to be clear on that.
Okay. So the reports by the Treasury and the Fed talk a lot about central bank digital currencies, which is, as Nellie said, a digital version of the US dollar. It doesn't really involve crypto. So I'm interested in what the other panelists think about. And I would say that there's a lot of emphasis on we should think about this, we should get ready. It's not an endorsement of doing it, but it certainly isn't saying like this is crazy and we should shy away from it. And as you know, the Europeans and the Chinese have already moved in this direction. So I have a couple, I'm wondering what the other panelists think about the concept of a Fed central bank digital currency, including if we have that, then do we need a stable coin at all anyways? Paige, you want to start, but I'll let each of you speak to that since there seems to be a lot of interest in that.
Sure. Yep. Well, I mean, I think first we kind of need to distinguish, as I believe that as the Treasury reports do, between, a retail CBDC and a wholesale CBDC. So, obviously retail would be something that, consumers and, small businesses and, entities such as those beyond just commercial banks would have access to, a direct liability with the central bank. And, I think that Tananson referenced the title of one of Governor Wilder's speeches, which is, is CBDC a problem, a solution in search of a problem? So, I think that in terms of a retail CBDC, some of the purported benefits include, increased financial inclusion, increased speed of payments, and, so far, we don't see any evidence for that those benefits would be realized by a retail CBDC. And, furthermore, we believe that there would be significant risks from a retail CBDC because having a direct liability, the ability to have a direct obligation of the Federal Reserve would probably, especially during times of crisis, lead to, significant flight to quality out of deposits from, banks. And, even potentially money market funds, which could significantly disrupt the ability of banks to perform their credit intermediation function and, could result in significant financial risk that could cascade through the economy. So, that's a concern that we've raised. And, there have been some potential ideas floated about how one could control those potential risks. Putting caps on the amount of CBDC is one that some have discussed. And then one would be limiting or preventing, interest paid on a CBDC, right. A retail CBDC. And we would just note that, the concern with some of those solutions is one, putting a cap on the amount of CBDC one could have access to. It still could potentially drain a significant amount of deposits out of the bank, the financial system, such that they would not be available, to lend or to fund, economic functions. And with respect to, capping the interest rate or limiting the interest rate, just historically looking At other times when, supposed caps or limits have applied to the Fed, I believe, we looked at one of the repo-based facilities recently, overnight repo-based facility that was, supposed to be capped and limited, and then, political and financial pressures ultimately led the Fed to, increase, the caps on the volume of that facility. So, there's some concern that any cap maybe would not essentially be held to. In terms of wholesale CBDC, I think particularly as many have discussed and work continues, I think in the cross-border context, especially, there could be a potential use case there, but the same kind of some of the similar obstacles currently that sort of are the reason why international payments are slower and more expensive still need to be addressed, including, differences in BSA, AML, illicit finance requirements, and transactions, and so.
Interrupt BSA, Bank Secrecy Act.
Oh, sorry.
Yes.
Yes. Sorry. Yes. Bank Secrecy Act, illicit finance, we can say, just differences in countries' controls, requirements in that regard. And then in terms of cost, I think Kristen mentioned, the possibility that stable coins could reduce costs and on a cross-border basis. Currently, there's still kind of the cost of, the FX aspect, the foreign currency exchange rate. And again, at some point you have, if it's, not a stable, if it's not denoted in a fiat currency, there still may be transaction fees to off ramp back into fiat currency, and, maybe even potentially, off ramp from, a US CBDC to, a Euro CBDC. So I just think there's still a lot of work to be done, which, Treasury obviously has cataloged, extensively in these reports.
So Kristen, where are you on the CBDC question? Do we need one, and would it eliminate the use case for stablecoins?
Yeah, no, I think it's an interesting question. I think the crypto industry is, sort of agnostic to mildly negative on the idea of a CBDC. I think it really kind of goes to what Paige was saying. Like, there's retail versus wholesale, two totally different discussions. And I think that the design choices that go into a CBDC are incredibly important. I mean, if we look like at China's version of a CBDC, for example, like that is largely a tool for surveillance on their citizens. Like, we don't want that here in the US. And I appreciated that the reports acknowledged having democratic values and privacy as part of a CBDC, because I think particularly at the retail level, the last thing we do is the government has the database of all the transactions. We don't necessarily want them to be able to get in and follow every little single thing that every individual citizen is doing. I think having privacy as a feature of that is important. It's interesting because we sort of open this discussion as, well, why do we need stable coins if the existing system works fine? We would sort of be like, well, why do you need a CBDC? Because we're already doing that over here. So, 8 years later, when you figure this out, we'll have already taken over the world. So yeah, for us, it's a very theoretical conversation. It's like, I mean, look at Fed now, right? Like, that's more like Fed when? Is that coming at any point in the like, this is we're doing stuff in crypto, we're innovating, and we're able to do it because you don't have to have the same level of research. You can kind of go out and test these ideas and use kind of the power of open source software to power these things. So yeah, but again, it doesn't necessarily mean that there isn't a role for one. And I don't think it would necessarily mean the end of stablecoins either. I think there is a real question though, as to what are the goals? What are the reasons we want to do this? Is it retail versus wholesale? And ensuring that there is, an appropriate level of privacy, I think would be really important.
Thanks, Johnson. You can speak to that, but let me ask you another question as well. I understand what you think about the some of the arguments in favor of these new technologies, but if tomorrow you found yourself in Nellie's job. What are the things that you think the government should be doing to balance the tension I identified at the beginning of our conversation, encouraging socially useful innovation, but avoiding putting consumers, businesses, the financial system at risk or entrenching incumbents? What do you think? What would you recommend to them? But you can speak to that, or just if you want to add to the CBDC thing, that's fine. But I think we've pretty much covered it.
Sure. I'll touch a little on the CBDC point just to say that I echo what the panelists talked about, in that a lot of it will really depend on the design choices and the fact that we have to factor in like financial, technological, geopolitical, and privacy concerns. Like, I'm somebody who thinks a lot about communities at the margin, historically excluded groups, vulnerable communities. And so for me, I would be just very curious to see where the privacy concerns like land, and making sure that actually is something that is front and center. And I was also happy to see that at least the language in the report reflected that. But in terms of your other question on if I found myself in undersecretary.
As you can see, it's a very nice office, so don't turn down the offer.
Lovely office, I love it. So I think I would actually urge people to go back to the problems, the pain points, the actual needs of the groups we purport to serve, because even with the reports, and I understand that likely it was because the executive orders wanted responses to specific things, but it seemed that when we're talking about future of payments, we started with the technology first, and not necessarily thinking through like, is this, and I don't want to say that you didn't think it through, so please don't misunderstand that. What I want to relay is that a lot of these debates are just kind of reimagining the technology itself, the digital assets themselves, and the solutions, and trying to tweak the solutions here and there to then retrofit to the problem, versus start with the problem, the pain points first, because even words like financial inclusion will get thrown around, and then there's not a specification as to, well, what element of financial inclusion are we actually addressing? And so if we just look at digital asset space, crypto assets, stable coins, I would start with then the operational risks, like looking at the technology, what makes it more susceptible to bugs and hacks? What are the governance structures that might disincentivize people to, make changes when necessary, or the governance structures that might lead to additional conflicts of interest? Because if you start with the technology first, you might arrive at like different solutions in terms of maybe we don't want certain elements to enter our ecosystem, or maybe it is fine, or we have a response to some of these risks. But it's always start with the pain point, start with the problem, build from there. And I think even that was kind of a reflection of my first comment, which is I feel like a lot of our debates around payments in general have been skewed towards the technology first, and not necessarily thinking, well, are there alternatives? Like, why did it have to fall within the digital asset space to begin with? And we're seeing this even with the real-time payment system. This took forever, yes, but if this is, and I was glad to see this as a part of the recommendation, if this is a priority, then let's make sure that this is done well. Let's look at the technology that's going to be introduced. Does it fit within our existing infrastructure? Is it interoperable with our existing infrastructure? And then thinking through very thoughtfully about then how do we make sure that we actually reach the marginalized communities that we say that we want to reach.
Paige, on this little site we're using to collect audience questions, people can vote up questions, and I don't think you'll be surprised that doesn't look like the banks are the most popular people on this audience. And I think there's a general sense, the question is a little bit poorly framed, but some people seem to think that the banks have held back on real-time payments and providing access to payment rails because you're trying to protect your cut of the pie. And I just wonder how you respond to that. I'm sure you've heard that claim, but somehow the banks have been an obstacle to progress because of all that's gone on.
Yeah, no, I mean, right. We have, certainly I've heard that claim. And I mean, the response is, I think I tried to mention previously, no, banks are very pro-innovation, pro-competition, but, that said, pro-competition so long as competition is kind of done on, level footing, right? So same risk, same regulation, basically. And so banks are subject to, obviously, everybody knows, significant, as Nellie mentioned in that the PWG report, outlined, significant prudential regulation, but also significant Bank Secrecy Act and AML, not just regulation, but oversight, supervision, examination, direct, eyes of the regulators and the supervisors in the banks, significant obligations with respect to managing cyber risk, right? I mean, we've seen a lot of hacks, a lot of crime occurring, and not just in the crypto space, but certainly there. The banks have, for years been developing, robust technology and systems to detect and deter, bad actors. And I think that is a space where the government and the public and the private sector should, come together and, sort of launch a whole of government, public-private initiative to root out criminals that are targeting, unsuspecting consumers. And, we have seen it in the P2P space, for example. And so, there's also the consumer protection element, right? I mean, we've kind of been saying to ourselves and been discussing, some of these consumers, to the extent they've gotten involved in the crypto space, have been sort of unsuspecting. There hasn't been adequate disclosure. There hasn't been adequate education, so we'd like to see, as I think the Treasury reports recognize, the CFPB to work with other regulators across the government to provide robust education and oversight of these entities that are basically, operating in the financial services marketplace, and for the oversight in all of these regards to be consistent across, the regulated entities, the banks, and then the unregulated.
So, Kristen, I'm going to caricature what the banks say. This is not to be associated with Page. The banks say we have all sorts of oversight and regulation. In fact, we have too much, and we'd like to undo some of it. And if we have to compete with all the people in decentralized finance and crypto, we want to make sure they have the same regulatory burdens that we do, the ones that we think are justified and the ones that we think are unjustified. So how do you think about that? And to what extent do you think the industry thinks that we need more regulation here, both, as you said earlier, to force out the bad actors, but also it seems to me that the regulatory imprimatur can provide legitimacy to some things that a lot of people are suspicious about. I didn't mean to give you your answers, but that's
it's hugely important, because I think that it's funny, right? Because there's often this criticism of, there's no regulation there, and then when different crypto companies attempt to become a bank or try to be regulated, then there's like, oh, well, we can't regulate you. And it's like sort of this like chicken and egg thing. But I think listen, I think Congress is really getting close to getting stablecoin bill done. I know that the House Financial Services Committee on both sides of the aisle have been looking at this very closely. And I think, as the President's Working Group report found, like, there's a gap here. This is something different that we need to make sure we have an appropriate framework for. And so, I think we would welcome appropriate regulation. We want to make sure that it's not something that is so burdensome that it applies solutions to risks that aren't there, given that this is a slightly different technology, right? I mean, we often hear sort of same service, same risk, same regulation. Well, it could be the same service, but it could be different risks because the blockchain is different, right? And so we want to make sure that if there's additional risks we see in digital assets that we don't see in the traditional world, that we have new regulation, but vice versa. If that risk is mitigated because there is a blockchain and there's transparency, then we don't need to have that same kind of regulation. But no, I'm very hopeful. I would love to see Congress get something done. I don't think it's out of the question that could even happen before the end of the year. I mean, I think there's a lot of momentum right now around getting a bill done. Some of them we've seen we have some issues with, and we're having good dialogue, with members of Congress to try to, provide some suggestions on how to fix that. But yeah, no, I think it would be an important step, and one that the industry has come around to. Right when I started this job 4 years ago, I don't think there was a whole lot of appetite for new regulation, and I think the industry has really evolved in their thinking, and the time has come that we need to put some guardrails in place.
Right. So I want to ask one final question from the audience, and then I have a final question for Nellie. A couple of people in the audience have asked about Brazil's PIX system, PIX, with which I'm not familiar, but I understand it's basically a central bank run instant payment system that doesn't involve crypto. Are any of you familiar with it enough to talk about the pros and cons and its applicability to the US?
I can mention it. So PIX is, in some sense, a retail instant payment system. It's like a real-time gross settlement payment. So think of FedNow, think of RTP. What they did was introduce it maybe 2 years ago through their financial system, through banks and non-banks, and they kind of pushed it out like pretty aggressively. The take-up rate was like 70% within like 18 months. Is very, very successful from that. So it's just real cheap payments. So Sweden and Norway have instant payment systems too that everyone can access, and has all the efficiencies that I think FedNow could create. But at the same, so it is through the central bank. But I think a really important thing is the central bank is getting into the wallets available to consumers, of which you can access the instant payment system, a stable coin, or a CBDC. So it is just an illustration of there are alternative technologies that can, generate the same service. And they're trying to create a system that just, that includes and allows for all these things, including cash, probably. They may still use cash with the appropriate guardrails. And they might be different for each one, but it would allow for that. So there's a nice paper that I know the Central Bank of Brazil has a nice paper. The BIS also has a paper on the future of money and payments, and it discusses the PIX system and similar kinds of things. It's quite nice if somebody's looking for a reference.
So Nellie, can we close on just tell us where you see this going in the near term? Are there the report talks about enforcement and existing rules. It talks about new rules. And Kristen said there's constant hope that Congress will pass a bill. What do you think is like? What are the milestones to look for in the next 6 to 12 months? Recognizing that I'm not asking you to predict what Congress will do. I'm not that.
Yeah. Well, I'm glad you're not asking me to predict what Congress will do. So, but as Kristen says, there's a lot of movement to discuss stable coins. There's also bills out there on broader digital assets. I'm not as familiar with all those pieces. One of the first things that of the Money and Payments report is this Treasury-led working group to promote further work on advancing a CBDC. And that would look at policy issues as well as technological issues. And I think there was a commitment through this report for the Treasury, the Fed, the administration more broadly, the regulators who might have equity interests here to further make progress on it, really push hard on some of the tougher decisions. The Fed has said they would not move with the CBDC without broad public support, administration support, and congressional support. So one needs to sort of create and determine how to get that input and allow it in a way that addresses how the Fed can implement monetary policy and control its balance sheet with a CBDC, as well as the broader social issues such as democratic values, national security, US global leadership, financial inclusion. So I think there will be immediate setup of this working group, and there will be more communication by the Fed on their consideration, and there will be more, public engagement on on CBDC.
And on the other aspects that are in the report, do you anticipate rulemaking in the next 12 to 18 months, or are you just, if Congress are waiting for Congress, what's the?
So I think there in the future of money and payments, there was not an explicit recommendation for Congress to act, except for recognizing the PWG report that had already asked for legislation. The consumer report that I mentioned, the use cases, was more of a recommendation that urged regulators to use their existing authorities, understand how they should apply to crypto, maybe work collectively in a way that might provide more comprehensive regulation. I also mentioned that there is yet another report to come from the Financial Stability Oversight Council. And that report, they were charged with, one of their charges was to identify regulatory gaps. And so that, which was not for some of the others. So there, I of course can't front run anything the council will want to say and determine, but there's more to come, David.
I'm sure there is. Okay, well, our hour's up. I want to thank Paige, Tananson, and Kristen for helping to give us such a good perspective on the Treasury report, and of course, thank Nellie for taking the time from what I know is a busy schedule to join us today. The hope is that by doing these things, we can improve the quality of public debate. And you've seen I've tried to avoid getting so far into the weeds that the only people who can follow the conversation are the people who already have defined views on it. And I want to thank each of you for helping me in that modest goal. So with that, thank you all, and stay well.
Thank you. Appreciate it. Appreciate the comments.
Thank you.